In the name of God and high, welcome to the Forex training set. I have prepared this amazing strategy in the format of a very short, useful, and different video. A good strategy should have some advantages. It has to be formed constantly in the market. We have to check different factors and have a good reason for entering. It has to give us a precise and clear entry point. Never enter contradictory to the market direction because 50% of the success is in the direction of the market trend, and if one of our reasons is violated, we should not take the front. And the last specification is that the strategy should have the risk for high rewards, higher than 1 to 5 or 6. So we shouldn't be worried about losing trades, and this would become a precise, clear, and flawless entry point. This strategy has all the mentioned properties. Another point that I have to mention is that this strategy is not dependent on candle recognition, indicators, Fibonacci, head and shoulder pattern, triangle pattern, etc. And these tools are not recommended in any way because they don't have proper feedback. I hope you experience a very good positions using this strategy. Wishing you more and more success. Goodbye. In the name of God, I am so pleased to be with you here. The strategy is clear and concise, so focus your minds for a few minutes. If you don't understand, go back and see the video again. Okay, let's move on to the strategy. Imagine these 6 candles are daily candles. The difference is that the candle on the left have no shadow, but the ones on the right side have a shadow. Definitely, we can't see candles that have no shadows, like candles on the left side. In this way, we see that if 3 candles have shadows, it means that it has been opened in this area. It has come down to this range and goes up to this range, but finally is closed here, same as the next candle and the next one. Now if these 3 are daily candles, the result of these 3 candles in lower times like 15 minutes will be this uptrend. The market is constantly making new highs and new lows. The market goes up in a stepwise manner. And now, if those 3 candlesticks were green, they were red and had shadows, this was a downward trend. That is, it constantly built lower minimums and permanently formed lower maximums. Have you ever thought about this issue, that why does the market constantly retest and move like this? Well, we have 3 professional platforms called ADAS, Wolfisk, and Ninja Trader. These 3 platforms show us the entered volumes with numbers. In addition, it provides tools such as order books, time and sales, footprints, and etc. We can use them very well and see the important volumes. This analysis is simply done to get you acquainted with these correct market trends and not to turn to useless tools. Well, in each candle, there is definitely a heavier volume than the others, which shows in this way. A black square is drawn around that volume and shows us in this way. These squares, the heavy volumes entered in each candlestick, are called POCs. POC stands for point of control, and these are the reasons why the market moves step by step, that the market has to go back and retest that volume and keep moving like this again. Here was a volume. The market in this area has gone to the next candle. It was opened here, came back, and came down. Here it tested the heavy volume and went up, and so the market has moved this way. Well, these gray squares are the same POCs that react like in this candle. If the price is closed in this range, the next candle that wants to form has to calm down, retest this POC, go back and go up, and finally, there is a heavy volume in this candle again. The market price has to come back again, calm down, retest this, and go up again. Now you need to learn what support and resistance are, why it breaks, and why it reacts to those limits. Support and resistance are very simple, but I'm going to tell you a point that no one mentions. If we draw these market turning points, we see that when the market reaches that point or range again, it reacts in this way, or it breaks and rejects, or it reaches that range and falls again. And the support side is the same rule that if we draw this range, the market may come back to this range and go up, or it may break and fall like this point. Well, we can see that after the failure of this range, the market did a retest and then went up. Then it came back again and reacted again to this range. The reason, as we said, is those volumes. If we consider this process 2 or 3 candlesticks daily, we see that there was a POC here. It was so heavy that the market had to come and retest it and then keep moving. The reason for breaking this range is the same heavy volume. Many people in this area are waiting for the market to reach this area and get out of this range and open the position down. But a heavy volume has entered here that has overcome all that sell volume, broke it, and the market has changed direction. The heavy volume we see here is back in the market. It reacted to it, retested it, and then moved up again. After learning support and resistance, we have the trade line, ascending trade line. Certainly, when our trend is downward, we can draw a downward trade line, and when the trend is upward, we can draw an ascending trade line. In such a way that if we have a minimum here and a lower minimum is formed, we can draw a descending trade line through these two. That we see the second, third, fourth, fifth points are achieved and the market constantly reacts to this trade line. And also, if it was ascending, we connect the two ascending minimums, one lower minimum and one minimum higher than the first minimum. And there is an ascending trade line that will react to that ascending trade line in the future. Well, we said that the reason for this movement is the zigzag of the market. These are the volumes, and these volumes are the areas that eat heavier volumes and are called POCs. They react and the market moves like this. As you see, when we have a maximum here and a newer maximum is formed, it means that it hits the previous maximum, passes it, and goes up. It means that there was a heavy volume here that could cross this range, so it means that our trend has gone up and the market is going to go up and move up again. That was the heavy volume of this range, right? And we know if the market is going to retest and come down and go up again. It can came up to this range or even lower and then move up again. So when our previous maximum was hit in this uptrend, and there was a maximum higher than the previous one, that is, our market trend is ascending, and the market is going to retest and continue on its own way. It is the same in the downtrend that when it rejects its previous minimum and a newer minimum is formed in the market, it means that the market wants to move downwards. And it's supposed to come to this range, which was a heavy volume, conduct a retest, and move downward again. Well, now we think the market retested and came down to these limits. And now we know that the market is going to move up and ascend. Well, this is in a 4-hour time frame. And this is in 15-minute time frame. This is the red line that came towards the descent and we drew around it. Suppose this is a downward trend in 15-minute time frame. Well, the market has reached this range. We know that the volume has been hit in these areas. Well, this is the same range. This low point is the same range, which may be the same heavy volume. What do we need to see here to enter the buy position? We definitely have to have a very good and logical reason to enter. We see that a trader has traded in the same way. That means we had a minimum here. The market has hit its previous maximum, which means that the market is going to move up. And we see it coming down. Well, that was the retest. That was the heavy volume of these areas, and well, it was supported by this area and went up to the high. Well, you can find many entry points here. But this model of entering with such a risk and reward is completely wrong. And the point I have to tell you is that do not use Fibonacci indicators and things like that at all. And do not take these risks and rewards at all. It is not recommended. Not 1 to 2 is not really recommended. Not even 1 to 3 and 1 to 4 is not recommended, and it is low. Well, we see that our dear friend, our trader, has now reached a point of entry in this area. I do not know how it entered, but the exit point is in this range. And its stop loss is down here. Well, what would it be like if we wanted to enter this position? We were entering the position at the black spot. Our stop loss was coming down, and our TP, our target with the person who hit this trade, is the same. And here the proportion of our risk to reward was 1 to 8 or 1 to 10, and the risk to our reward proportion was very high. But how? What do we have to see here to get into position? That we do not trade like this. If we trade like this and our risk and reward are so high, our risk will be very low. Well, we see that we are in the same range in the 4-hour time frame. Came to the market downturn. In the 15-minute time frame, we go down and see that the market has reached the desired range. These limits, well, we see that now we're going to look for a position here. The position we're going to take is with the trade line. That is, when the market came down in 15 minutes and reached the desired range and it had a good modification, we know the market will go up. When the market reached to these limits, consider here to here, we know the market may go up. Now from here to here or come down and go up, we're just thinking about getting a buy entry point here. In what way? Through trade line. It means that we have a minimum here, a higher minimum is formed here. If we draw a line, we see that the third point is obtained in this range. And here we could come in and make a small stop loss and a big TP. And now what is our point of entry? When a descending candle hits this line and gives us an ascending candle, after closing this candle for 15 minutes, we enter the position and place our stop below this range. And we put our TP on the peak of 4-hour time frame. This is our entry point like this. When we draw a trade line here, a red candlestick hits our trade line and gives us a green candle. Here, after closing this green candle, we enter. We enter the buy position and drop our stop down here. Even if we stop a few times, we will suffer a very, very small loss. But unlike the trader who took the buy position here, if we put our stop down here, we would have to take a lot of risks. This positioning model is not recommended and it is very, very wrong. In this way, you can take the risk to rewards proportions like 1 in 10 or 1 in 15 and even 1 in 20. Well, friends, I will explain to you on Paint, and after that we will go to MetaTrader for check where it entered. We said how is the uptrend? So we have a peak, an uptrend, a downturn. We have a peak here, and when the market comes to this range and rejects the previous maximum, that means it crosses the minimum. Upwards means that our market is ascending, and we're just thinking about the buy position, the long position. But when? Just when the market modifies. It means that if we enter from here and stop here, it is not interesting at all. We wait for the market to come down in the modification, and after that, here we get the entry point so that we can enter the long position. Now I will draw some upward trends for you and explain them to you. Well, now we have 3 uptrends. Pay attention. After the trends were formed, we draw a horizontal line on the previous peak. Now, where should we look for the entry point? Think that it had modified up to here. This one has modified up to this point, this up to here, this one up to here. Now this is back from here. And go up, this one as well, and this one also. Okay, look. When the market modifies until it reaches that range, it has not reached its previous maximum. We do not take positions even if we receive signals here. I mean, if I saw a signal here, I saw a signal here, I saw a signal here, I will not enter at all until it comes to this line of mine. From now on, we're looking for a buy position and an entry point. Even if it comes lower, its credibility increases, which means that we take a position in these 2 situations. But when this line does not collide, we do not consider everything we see as the entry point. Because this may be fake, and well, it did not retest the volume that is here, and it may be after it entered the entry point here. Come back and come down, hit our stop, and we will lose. It is best to hit the line or cross the line and calm down. The sell position is exactly the same. It makes no difference. Be sure to wait until the market modification reaches to its previous maximum or minimum. Do not enter the position at all before that. Well, it was in the 4-hour time frame. We find the trend in the 4-hour time frame, and when this happened, the market reached its previous minimum or even passed it, so from now on, we have to go in the 15-minute time frame and get the entry point here. So we draw 2 items, the uptrend and the previous maximum. Here we have 2 cases. Well, we go to the 15-minute time frame. Well, this is the same as the ascending trend, but I want to draw in the 15-minute time frame for you. The market fluctuated in this way in the 15-minute time frame and finally reached the previous maximum of the market. Well, from now on, we were supposed to look for a buy position. So when the market reaches this line, we were supposed to just look for the long position. Well, it's over now and we are in the 15-minute time frame. And we said we could enter through the trade line. In what form? It was like we see a turnaround here. A smaller return. The market has gone up again. This is what happened. We can draw a trade line. And again, when the market came here, and a little candle gave us a little approval after this candle, we entered a position, we put our stop under this process, and put our TP up here. Simply in the 4-hour time frame, we were supposed to form a trend and draw the previous maximum of the market. Well, these are 2 points. Here, 1 point was that after hitting the line, we could draw the trade line. That means we could not draw a trade line here. We couldn't draw it here. When this happened, we could draw our own trade line. And when we draw the trade line, the market should come and hit this line. Do not enter the position at all before it hits this line. I mean, even when this happened and you lost your position, there's nothing to worry about. Wait for the candles to hit your trade line and give you an ascending candle and a confirmation after the collision. You must not have entered here when the red candle hit it. Stop! The market may hit your stop. After the confirmation candle, you enter safely. Put the stop down here and put your TP on the previous peak of the market. This way, you get a very accurate entry point and the risk to reward proportion will be very high. And you no longer have to worry that if you lose your 5, 4, 6 trades, you will get emotional and make wrong decisions. You end up losing 5 trades in a row or 6 trades in a row. No worries. As I said, the risk to reward proportion of this strategy is higher than 6, which means a minimum of 6. 7, 8, 10, 15, and even 20. We even had a risk to reward of 1 to 20. Well, this way it is very simple. Well, now I want to go to MetaTrader again and explain the entry point that I specified to you there again so that you can understand very well. So we were supposed to practice 3 places together. Our first practice was on PowerPoint, our second practice is on Paint, and the third is on MetaTrader. It's very simple and comfortable. I hope you understand very well. So now let's go to MetaTrader. Well, we came to explain this strategy to you on MetaTrader. This strategy is a very good strategy. I have never seen such a strategy anywhere. Please think about these for a few minutes. Concentrate until you understand this entry point that I show you in MetaTrader very well. Well, now we are in the currency pair of Euro USD in the 4-hour time frame. We were supposed to analyze in 4-hour time frame, do some work here, then go to 15-minute time frame. And our entry point is there. Well, the first thing we had to point out was this trend. It means a downward trend movement, a correction, and a downward movement. What happened? It rejected its previous minimum, which means that it broke this minimum and came down. We said that when this happens, this minimum will be broken. We draw a trade line on the previous minimum here. This is what we have drawn here. We said that this is a heavy volume, that the market has passed it and gone down, and then it has to remember to retest this heavy volume, this point of control, retest this POC, and then continue its downfall movement. Well, we recognize the trend here. We also drew our previous minimum. Well, we said the rest of the work is in the 15-minute time frame. On what condition? Provided that the market corrects and reaches the point we want. Well, now it's arrived. That's right. Think of this green candle, this hit here. And now we go to the 15-minute time frame to be at the entrance. Well, this is the same green candle that hit here. So what was our point of entry now? It was like we draw a trade line. I mean, we could not draw a trade line here because it had not yet reached that blue line, that heavy volume. And now that it has retested the heavy volume here, we're going to build a trade line. In what way? In such a way that we connect all the endings of the shadows. We also want to connect the ends of the candles. It means a trade line will be at the minimum of the candle. A trade line is at the minimum of the shadows or the shadows. Well, we connected this. It came here. Unfortunately, we missed this opportunity here. Why? Because it didn't go up to hit one of our trade lines. We get to that entry point when the market comes, for example, to this green line. Think this is the same market that reached here to this line, gave us a red descending candle, right? That was what we were supposed to do when the market reached that trade line. Give us a confirmation candle and we enter after the confirmation candle. Put the stop behind the same candle, right? Well, if it happened here, the market would reach here. There was a red candle. We would enter here, raise the stop, and now we would go in a 4-hour time frame. Well, we'll look and see that our last minimum is here. Or this downward trend has come down here. And now here, the modification that is finished may come up to here. This red line is also our stop loss. Well, when the price reaches here before it hit our stop and comes successfully down here, we see that we could get a risk to reward of about 1 to 15 or 1 to 20. We could take it here, a very strong risk to reward and a very accurate point. But we see that two things happened. One is that it has not reached our entry point. It has not reached that trade line. So we could not trade. Even if we've hit this trade, what happened? Look, we have to risk free trading and a partial exit. How? I have a minimum here. Suppose I traded and it came down to this range. Well, these ranges may bring the market back. I said there is no strategy works 100%. While here, when it reaches this range, we take out a part of our capital, then this so-called partial exit when it got here. So then we do a risk-free. What do? We come to our stop. It was the red line. We pick it up or we drop it at the point of our purchase or we drop it down. It depends on your mood and feelings. Now we see that it is riskier. It does not matter to it. It does not move the stop. Instead, it does the partial exit here and withdraws a part of the capital with a profit. And if the market comes back and stops like this, it does not hurt because it did the partial exit and a part of its capital has been taken out profitably. If it had brought it lower and the stop lower, it would have raised a profit from this and a profit from here that the partial exit happened. Well, now let's skip these two cases of partial exit and risk-free. Let's go to the other entry points. Here we have a trend again, a downtrend, a modification, another downtrend. We draw the previous minimum here. Here we consider a drawing line that was a heavy volume. The market passed the volume and in the modification, it was forced to come and retest it, then turn and come down. Well, we can place an order here, a sell order, then a stop up, but our stop grows and our risk to reward proportion becomes 3 or 4. We are finding this entry point in the 15-minute time frame so that our risk to reward here is so high. That is, our risk is so small and our reward is so high. If we were to lose $25 here, our reward, we would make a profit of about $300 or more against $25. This is a very good, but at that time, if we were to lose $25 in this range and our risk to reward was 1 to 3, we would make a $75 benefit, which was both high risk and low profit. But here, on the contrary, our risk is small and our profit is very high. So the trend we formed here, we also drew the previous minimum and well, the 4-hour green candle has reached this blue line, the same volume range. Well, let's go to the 15-minute time frame. Well, look, we had these two maximums. We draw a trade line and well, we see the prices different. See the one who did not give us a point of entry. You did not reach our trade line here. But here we see that it arrived, hit the green candle, and gave us a red candle. This is exactly what happened to us. We drew the trade line, the green candle came and hit and gave us a red candle. Well, this happened in the 15-minute time frame and gave us the entry point. After this red candle closes, we go in and drop our stops up here and wait to see what happens. Okay, where do we put our stop? Let's put it to the lower range where the market was, that is here. After the modification, we know that it may come down. When we entered this top, we put the stop up. And here we put our target. And here we can see how high the risk to our reward was. We said that the market may come to this range and after reaching this range, we will get the entry point. This way we drew a trade line and you see we have drawn the trade line up. We have a more accurate entry point. Here we get the range and here is the entry point. And this is the confirmation candle. When we enter, the stop is high and you can see how accurate the entry point was, how small our stop was and how well it reacted and reached the target. This is small risk and this big reward, which is about 1 to 10 or 12. Again, we have another entry point here. This is from our first entry point. We see again that the price has come down from above, had a modification, and again a downward trend. Both reactions are exactly the same. The above happened here as well. This minimum was the last minimum we had in the market. After it modifies and reaches this point, we go to the 15-minute time frame. Market has modified this blue line and has come up that from now on, we're looking for the entry point of sell. We are looking to get this sell position. So where can we draw a trade line? After hitting the blue line, we could not go anywhere. So far, we could draw a trade line here. You see, we could connect these two maximum. Here, the green candle hits this line, but it does not give us a confirmation candle. The red candle that we want to be here to get confirmation has not been given to us. Here we can draw another trade line, both the shadow and the candle. Be sure to draw two trade lines, both the bottom of the candle and the shadow. Our range was here when it reached this blue line. We were looking to get to the entry point. We drew a trade line here, but it did not give us the red candle confirmation, so we cannot enter. Here we can draw another trade line, both the bottom of the candle and the shadow. We see that the market has come and hit the desired area and has given a red candle. We said that after it crossed the line and gave a confirmed candle, it means the same candle. Here we can go in and stop exactly right here. We entered here and put a stop on top of this candle. If the market came up and stopped, we would lose a small amount. Well, now let's see how much is our reward. The market has come down to this level, and the last thing we anticipate is that the market will come down to this stage again. Well, look, we entered right here. That red line is our risk, and this is our reward down here. Look, all our entry points, all positions were the risk to reward of higher than 10. So far, we see that we have 15 to 20. This may itself be 15 to 16. This one is about 10 to 11. It gives us an excellent risk to reward and a very accurate entry point. It means we could have had 2 trade wins in 2 weeks, and our risk to reward was very good. If we had $1,000 in the account and the risk was 2.5%, that is $25. In this downward trend, one thing we were making about $300 profit, and next week we'll see that we would take a position that it came down to about 1 to 10, and again here, if we risked 2.5%, we would make at least $250. It means $250 here, $300 in that trade. We could make a $550 profit. If we had a $1,000, we saw that we made a profit of $550 in 2 weeks. $550 is about 55% of our total capital in 2 to 3 weeks, which is very great. This is something that many traders are looking for but can't get. Finally, we see that their risk to rewards is 1, 2, 3, and 4, and their win ratio is very low. There are a lot of stops, and they are the ones who wish to make 10 to 15% of their total capital per month. Someone who has $1,000 in his account, at least $100 or $100.50s are 10 to 15% of their total capital. We got about 55% of our total capital in 2 to 3 weeks in 2 positions. This is a very great strategy. If you do not understand, go back and focus your mind to understand this entry point very well. Well, I'll show you another entry point in the USB GPY. We are in a 4-hour time frame and our trend is upward. Past this maximum, a heavy volume was here, the market passed it, went up, and had to go back down to retest this volume. We draw a line and wait for the market to come and hit that line. And we see that it hits the line here. Let's go now in 15-minute time frame. Well, our modification is over and it has reached the limit that we had set. And now we're waiting to draw an ascending trade line. Well, we see that the first trade line we could draw was this. that we connect this to this, and well, there is no third entry point here. It was like the first case, but where could we draw the second trade line? Here, that is, when the market went up, it went down, it went up, we could draw a trade line. The third entry point is obtained. It was a green candle that was removed and turned into a green candle. After closing this candle, we enter, lower the stop, and go in a 4-hour time frame to target. We also target the area that the market has already reached. So this is our trend that came down after modification. And it reached our volume range. And now we start drawing the trade line that we drew. We entered here and made a small stop and a target that we see here that our risk to reward was about 1 to 20. Well, I will end this tutorial here. I will finish it. We taught you 3 places, one on PowerPoint, the second on Paint, and the third one here in MetaTrader. The best of which was the MetaTrader, where you could see with all the fluctuations that you could get very accurate and very good entry points with very high risk to rewards. Well, I have explained everything you need to know to trade with this strategy many times. I hope you have understood it very well. After that, it just depends on you and the exercises that you do. Practice it. You can find many entry points in the market. Look and find them, analyze, see where you could enter the position, where you could not enter it, where it gave you confirmed candles and where it didn't. In short, from now on, it all depends on you. I entrust you to the Almighty, the Merciful.